Let's keep talking about the bond. And we were talking about the bond valuation, the bond pricing. Now we're talking about some more things about the bonds. The first, we have some the introduction about the basic features of the bond and the related concepts. And then we're talking about different types of the bond. Then we're talking about the feature effect. And then in the end, we talk about the term structure. First, let's think about the difference between the current yield versus the yield to maturity. So the yield, without being specifically emphasized, when we are talking about yield, we are talking about the yield to maturity, or YTM. There is another concept called current yield. The current yield is defined as annual coupon divided by price. Remember that the bond price is the money, the investment that the bond investor is giving. Okay, the bond investor is giving not the face value, not the coupon. He's giving in the bond price. This is the money that he's given, not giving up. He's invested in to this bond, and every period, compounding period, he's receiving the coupon. If the compounding is annual, then he receives the annual coupon. So every year, his fixed income return. Remember why we call the bond as a fixed income financial asset? Because every year you can anticipate that you must receive an annual coupon. I input the bond price, this amount of money, and I get a return, annual coupon. So my return, or the yield for the current period, that's why we call it the current yield, is equal to annual coupon divided by the price. Okay. The yield to maturity is a total or average yield, annual return for this bond financial product from the beginning of the current year, from the beginning of the bond investment to the maturity date. If the bond matures in 3 years, so year to maturity is the average or the overall annual return over the 3 years. It has two parts. It is a sum of the current yield plus the capital gains yield. What is current yield? Current yield is a fixed return. It's a coupon benefit that you get from your investment every year. There is another one called capital gains yield. Capital gains yield is the return that you get from the change, from the increase. Well, if it's a decrease, then we call it a loss. Okay, it's not a yield, it's a negative yield. The increase from increase of the bond price. If the interest rate is going down, then the bond price will go up. Since you purchase a bond at a lower price, and you're selling this bond at later years at a higher price, then you're getting the another yield, and that return is called capital gains yield. Think about, like I said before, bond is similar to real estate, but with a maturity date. Think about that you are purchasing an apartment using the apartment price, and every month or every year you're receiving the rent. Okay, you rent it out to some person who rent your apartment, so you receive the rent. Coupon is like that rent. And every year the return is the annual rent divided by the amount of money that you invested into this real estate property. And the capital gains yield is like, after several years, the real estate price goes up. So the asset value appreciation from this asset you just purchased generates some yield to you. That is capital gains yield. And rigorously speaking, these two yields are different. The current yield is a fixed income. We generally call it an investment. And capital gains yield is more like a speculation. Okay, more like a speculation. Capital gains yield is something that you do not anticipate for sure. It has a risk. Because the bond price is is affected by the future interest rate change, which is not something that you can anticipate for sure. But for the current yield, this is for sure. That's why we call it the fixed income part of this return. Think about the example. If the coupon rate is 10% with semi-annual coupons, so for every 6 months, the coupon payment you got is 5%. 10% divided by 2. 5% times the face value, so 50. Okay, 20 years to maturity. So the compounding period, we have 40 compounding periods because every year has 2 6 months. And the current price is 1,194. No, 97.93. The current yield is the annual. Remember, annual coupon. So the 100 is paid twice, but in total it's 100 divided by the money that 1,197 that the investor really actually invested in. And the current yield is 8.35%. The price in 1 year, assuming no change in YTM, is 1,193. You can calculate it. Okay. Given the year to maturity, given the rates, given the face value, given the after 1 year and the coupon rate and all of this, you can calculate the value. So the capital gains yield is the price at the end of the first year minus the current price that you invested in divided by the current price. It's a price T plus 1 minus price T divided by price T. And you find the capital gains yield is negative 0.35%. Actually, it's not a yield, it's a negative yield, it's a loss. Okay, because the price is going down. Okay, the price is going down also because here the price is going down not because the interest rate changes a bit. It's just because although the interest rate doesn't change, the bond has some benefit that has already been taken. That is the first coupon payment. Okay, if you sell this bond to another bond investor, the second bond investor can only get the rest of the coupon payment in the future, plus the face value. But you, as a first coupon investor, already got the benefit of the first coupon. That's why the price must decrease a bit. So the YTM is equal to the current yield minus, plus the capital gains yield, but the capital gains yield is negative. So the YTM is 8%. Okay. The basic theorem of bond pricing is that the bonds of similar risk and maturity will be priced to yield about the same return. So the yield to maturities of the two similar bonds with similar risks must be similar or the same at the equilibrium in the competitive market, regardless of the coupon rate. Remember, regardless of the coupon rates. Okay. If the maturity is the same, the risk is the same, even the coupon is different, and the face value is the same, then the year to maturity must be the same. Because when the coupon rate changes, while other things are equal, then the bond prices will change. If one bond pays more coupon, the bond price will be higher because it gives more benefit, it gives more return. So there will be a larger demand of this financial asset, of this bond. So larger demand will push up the bond price. Okay, when the bond price is going up, then the capital gains yield, if the face value is the same, then the capital gains yield may be lower. While the coupon benefit is higher, so the two cancel out, the total, the combined yield to maturity must be similar. Okay, this is also true. This is also because in a competitive market, if two bonds are similar, have the similar risk, if one bond's yield to maturity is higher than the other bond, then the high yield bond will attract more investors. So there will be more demand. The more demand will drive up the bond price. And we know that when the PV is going down, RI is going, PV is going up, RI is going down. So the more potential investors are, the bond issuers will tend to lower the yield until the yields of the two similar bonds are almost the same in a competitive market. Okay. If you know the price of one bond, you can estimate its yield to maturity and use that to find the price of the second bond. And this is a useful concept that can be transferred to valuing assets other than bonds. So basically, in the competitive market, financial market, two similar financial products of the same type with the similar risks must have almost the same return. Okay. We will also detailedly talk about this later. Bond indenture. Indenture is just the contract. The contract. Okay, it's a term for contract. It's a contract between the company and the bondholder. The company is the bond issuer. The bondholder is the bond investor. Okay, who gives the money to the company in exchange for the bond. So it includes the basic terms of the bond. For example, the face value, the coupon rate, maturity, something like that. And the total amount of bonds issued. Why is this important? Because it matters for the risk of the bond. As a bondholder, I want to know whether this company is safe or not. If I know that this company is issuing $1 million bond, but it has like 2 trillion debt outside. What do you think about as an investor, how do you think about this company? You think this company is hopeless because there is no chance that he can pay all of this debt, and he has very high risk of going bankrupt. That's why, as an investor, I think this company is very risky. So I face a significant risk that I cannot get my money back. So as an investor, if I want to buy this bond, I will require a higher risk, a higher price, a higher return to compensate for my higher risk. So you need the company to disclose the total amount of bonds issued. Okay, I buy 1 million, but I want to know how many in total that you have issued. If you issue 1 trillion, that's a problem. If you only issue like 5 million, then I buy 1 million. I feel like it's pretty safe, and your company probably have like 200 million assets, dollars assets. Then I will be more assured. A description of property used as security, if applicable. So for some companies, they issue the bonds, but they have collaterals or mortgages. Collaterals are using financial assets to insure and mortgages use the properties to insure the bondholders that, hey, I borrow money from you, and I give you a proof. This proof is bond. To prove that in the future you can come with this bond to ask me for the money. If in the future I do not have enough money to pay you back, what do? I have the collateral or the mortgage, like a building or something. I can sell this asset and use this asset's sell price, so the money that I got from selling this asset, to pay you back, to assure the bondholder to make this bond safer. Sinking fund provisions. This provision requires the issuer to put money aside to repay bondholders at maturity. For example, you wanna you issue the bond and borrow money from the bondholders. But the contract, the bond indenture can say like you must provide a sinking fund, and that fund has the money or the assets with high liquidity, so that the bondholders will be paid if the company is going into some financial trouble. You probably are asking, if you already have money, why do you issue bonds? Right? Why? This is because there was some tax problem and also other problems. For example, Apple Inc. Apple Inc. produces and sells iPhone, iPad, this, but Apple Inc. also issued a lot of bonds in the U.S. to raise money to pay its employees. Why is that? Because Apple Inc. sold a lot of Apple products and get a lot of cash, but it hoards its cash in Japan and other countries with low tax rates. In the U.S., if he got his money into the U.S., then he will have to pay a lot of tax for the profits. So Apple's management team, they wanna hoard their money into somewhere and use this money as sinking fund provisions to issue debt, to issue bonds, because they are providing provisions using the cash. So their bonds are safer. So their interest rate is lower. So they actually pay lower interest to the bondholders to lower their capital cost. Okay. There are also other reasons why they wanna issue bond while they also have money. Call provisions. So call provisions. So callable bond is, we will also talk about the put bond. If you learned the options, futures, and derivatives before, the concept of the options include the call options and the put options. But the call provisions is similar to that concept. It's kind of related to that concept that allows the issuer to repurchase and retire the debt security or the bond, which means that as a bond issuer, I issue you, the investor, I issue you some bond with a maturity date in 3 years. But the callable provision gives me a right to repurchase this bond before the maturity date. For example, I find that the interest rate in 1.5 years, the market interest rate is getting higher. Okay, so the bond price is getting lower. I want to repurchase the bond that I just issued with a lower price. Okay, so that I'm actually trading the financial security, the bonds that I myself issued. So the call provisions provide the bond issuers a right, an option to repurchase and retire the bonds that they issued when the market condition is good for them. The bond indenture, some bond indentures also detail the events that can trigger the calling of the investments. It's a legal contract between the issuer and the investor, the bondholder. Some say like, well, if I want to retire, want to repurchase, I can repurchase it. And some may say, well, when the interest rate is higher or lower than some bar, and some may provide the other conditions. If the bond is called, the issuer will pay the investor the accrued interest, okay, defined within the provision up to the date of recall. The investor will also receive the return of their invested principal. But Is it just good for the investor? No. Because the call provision is giving the bond issuer a right to do something when at that time conditions are good for the issuer. And this is after the bond is issued, this is a zero-sum game between the issuer and the investor. So this provision is not good for the investor. It's not good for the investor. Okay, so the call provisions will increase the risk. The bond being called risk of the investors. So for callable bonds, the issuers will, the investors will demand a higher return to compensate for this higher risk. And there are also some other details of the protective covenants. Bond classifications. Registered vs. bearer forms. Okay, if you have the Hong Kong dollar, you can find that the register forms mean that the bond is registered with your name. Okay, bearer form means that this is not with your name. Think about the money. Money is like a bearer form because you can give this money to that guy. Okay, but your real estate property right, ownership, that one, you cannot just give this to another guy and he can trade this property ownership certificates on the market. You cannot do that because you have your names on them. So that is registered form. For the bearer form, anyone who currently owns the bearer form financial assets are recognized as the owner. For example, paper money. Okay, if you look at the Hong Kong dollars, $100, it says promises to pay. If you have the $100, it says promises to pay the bearer. Okay, $100. What does that mean? That actually means the $100 is not really government-approved money. It's a debt. It's a debt that the issuer bank is owing you. The issuer bank gives you that looks like $100, but that is a proof that if you ask the bank to give you $100, they will give you $100. But that paper is not $100 themselves. If you look at the $10 or some other dollars issued by the government, those are government printed money. Okay. So anyway, anyone who, for the bearer form as financial assets, for example, bonds, some bonds, anyone who holds the bond currently will be recognized as the owner. Because the bond doesn't have your name on this. For some bonds, they have your name on it. So you cannot just resell it very easily. Security. Like we discussed before, the financial the bonds secured by collaterals and mortgages are safer. Okay, collaterals are the bonds with collaterals are secured by financial securities, and the bonds secured by mortgages are secured by the real property, normally lands or buildings. Debentures are unsecured bond, so basically it doesn't have any collaterals or buildings. Notes are also debentures, but notes are we usually call notes the bond. We call the midterm bond with maturity ranging from 1 year to 10 years as notes. Short-term bonds with maturity less than 1 year, we call that bills. Okay. Seniority. Bonds have different seniorities. Some bonds are senior than the others. Okay. Senior bond mean that when the issuer is bankrupt, the court will ask the company to go into a bankruptcy process and to liquidate the company's assets. And liquidated assets will be used to pay the senior bondholders first. Now, after all the senior bondholders' money being paid off, then the junior or less senior bondholders will be paid. Until all of the bondholders are paid off, if there is still some liquid assets left, they will be used to pay the stockholders. Bond characteristics and the required returns. The coupon rate depends on the risk characteristics of the bond issued. And these are 4 questions. Which bonds will have the higher coupon, or else equal? From the first sentence, we know the claim. We know that when the bond is riskier, the other things equal, the investor will demand higher coupon rate. So basically, these 4 questions are asking which bond is riskier, and those bonds will have a higher coupon rate. Which bonds are riskier? Secured debt versus a debenture. Debenture is riskier. Subordinated debenture versus senior debt. Subordinated means not senior. Okay, not senior. You see a sub, you know it's not senior. So subordinated debenture is riskier, so it has higher coupon. A bond with a sinking fund versus one without. Of course, the one without the sinking bond is riskier. A callable bond versus a non-callable bond. Because callable bond is giving the issuer some option to repurchase the bond. It is riskier for the investors. Okay, it is safer for the bond issuers, but it is riskier for the investors. Bond ratings. In the very first lecture, we talked about the credit rating agencies. They analyze the bonds in the market and give the ratings. Moody's, S&P Standard & Poor's, and Fitch. So they assign high grade, medium grade, and low grade and very low grade to each bond. Each company bond, corporate bond, and government bond. And the bond traders, sometimes they just take the credit rating agency's ratings as reference. Okay, and when they find that all the 3 credit rating agencies give lower grade to a bond, we know that the bond price will go. The bond price will go lower because when the bond is recognized as riskier by the market participants, the required interest rate will be higher because it's riskier. So the market demands a higher risk premium. We call that risk premium. Remember that risk premium is not an interest. Is not a risk premium is a risk-free rate plus the risk premium equals the total interest rate that you see, the required return that you see from this financial asset. So the bond's risk premium is higher. The bond has a higher interest rate, so the bond value, the bond price is lower. Okay. Government bonds. The U.S. government bond is the cheapest financial asset in the world. Cheapest meaning that the interest rate is the lowest. Okay, because it's the safest. People do not around the world, at least currently, people do not think the U.S. government will go bankrupt easily. So the Federal Treasury the Department of Treasury is issuing bonds, and this is the federal government bonds. And this bond can be called bonds if the bond's maturity is greater than 10 years. Or notes if the maturity is between 1 and 10 years, and T-bills, Treasury bills. It's a pure discount bond with original maturity of 1 year or less. Why it's called pure discount bond? Because it doesn't give you coupon. Why it doesn't give you a coupon? Because the maturity is too short. So basically, when T-bills are issued, you will just hold the bill till the maturity, maybe 3 months, maybe 6 months. Then after in 3 months, you will get the face value. Okay, so because T-bills are without the coupons, are not paying coupons, so its price or its present value is just this face value divided by 1 plus r to the power of t. Okay, because T and R are positive, so the bond price must be lower than its face value, and that's why it's called a discount bond. And also, it doesn't pay coupon. That's why it's called a pure discount bond. Okay, the 3 month is the shortest term Treasury bill. The 3 month U.S. Treasury bill is usually regarded as the safest financial asset in the world. And that's why the interest rate, the year to maturity of 3 months Treasury bill is usually referred as the risk-free rate for all the financial security as a benchmark. Okay. Besides the federal government debt, we also have the municipal securities. The municipal securities are being issued by the U.S. local governments. So there are varying degrees of default risk because in the U.S., the city government can go bankrupt, like Detroit. The interest received is tax exempt at the federal level. So the federal government is not taxing the interest from the bondholders who invest in the municipal securities. Okay. Oh, by the way, all of the bonds when you have the coupon payment, and whenever you sell the securities and gains the capital gains yield, these are capital gains. All of these are capital gains. When you use the money, your investment to make money, these are capital gains. All of these capital gains can be taxed, okay, at different levels. But municipal securities are not taxed at the federal level. The U.S. federal government can tax you. The municipal government, the local government can also tax you at different levels. The government bonds example: a taxable bond has a yield of 8%, and a municipal bond has a yield of 6%. If you are in a 40% tax bracket, which bond do you prefer? I do not think 40% is too high. 40% is pretty reasonable in the U.S. and European countries. Okay. So you think that the taxable bond is giving you a yield, a return of 8%, but actually 40% of this return will be paid to the government as tax. That's why the effective return to you as an investor is 8% times 1 minus 40%, which is 4.8%. Okay, compared to 6% return on the municipal, you think municipal bond is, although its nominal yield is lower, but actually it's better. Since most of you as students haven't worked yet, so you probably don't know much about the tax. That's if you find a job and go to work and you have the income, part of your income will be paid to the government. Why? Because the government needs your money to hire the policemen, to hire the cleaners, street cleaners, the public hospital doctors, the public school teachers to provide the public benefits. Okay, the public service. So they need money from you. At what tax rate would you be indifferent between the two bonds? That means that you are indifferent. You can choose either one. That is, you assume that the tax rate is T. Then the after-tax effective return to an investor for the federal bond will be 8% times 1 minus T. When you are indifferent, you should know that you should make it equal to 6%, and you calculate and find that T is 25%. Okay, at 25% tax rate, you are indifferent between the federal bond and the municipal bond. Zero coupon bonds, it doesn't pay any coupon. So the 3 months T-bill is a zero coupon bond. The entire year to maturity comes from the difference between the purchase price and the face value, the par value. And you cannot sell for more than the par value because before the maturity date, the bond price must be the par value divided by 1 plus r to the power of t. So it must be smaller than the par value. Sometimes they are called zeros or deep discount bond or OIDs, original issue discount bond. They are just different names. Treasury bills and principal-only treasury strips are good examples of zeros. What is strip? Strip is separate trading of registered interest and the principal securities. Okay, strips are basically a financial product that separate the principals and the interest. So for strips, they only have the principals being paid. Principal is a face value. Okay, so strips do not, the principal only treasury strips do not pay coupons. So they are also an example of zero coupon bond. Floating rate bonds. So there are two different bonds according to the R, the year to maturity, or the coupon. The coupon rate. For some bonds, the coupon rate are fixed, and they are fixed income. And for some bonds, they are the coupon rates can change. So we say the coupon rate floats depending on some index value. Example is adjustable rate mortgages and the inflation-linked treasuries. If you purchase apartments in Hong Kong, for example in Shenzhen, then you will be provided two options. The first option is that the mortgage rate is fixed. So every although this is not really bond, this is a debt. Okay, this is not a standard bond contract. This is debt, but effectively you borrow money from the bank to buy this property. Okay, buy this apartment. So it's kind of like you issue a bond and you borrow money and you pay back the mortgage. One option is that the mortgage is fixed, for example, at 4.8%. The other option is that this rate is tied to a benchmark rate. So it says your mortgage rate will always be the central bank, the People's Republic of China, People's Bank of China, People's Bank of China, some benchmark rate plus 2%. So if the benchmark rate float, then your total mortgage rate will change. Inflation-linked treasuries. There is a small proportion of a small type U.S. Treasury bills are inflation linked. So it says the rate will change, adjusted according to the adjustment of the inflation, the CPI. We were talking about the price risk and reinvestment risk. For the price risk, the floating rate bonds have lower price risk because your rate, okay, can change according to the market condition. If the coupon floats, so it is less likely to differ substantially from the year to maturity. But you probably will ask that when the benchmark risk or the benchmark interest floats a lot, then the coupon rate will float a lot. Actually, some coupons may have the collar, the upper bound or lower bound, or the ceiling or the floor of for the coupon rate. So the coupon rate cannot go above a specific level or below a specific level. Other bond types: catastrophe bond. It is a high-yield bond instrument that is designed to raise money for companies in the insurance industry, an insurance company, in the event of a natural disaster. The catastrophe bond allows the issuer to receive funding from the bond only if specific conditions, such as an earthquake or tornado, happen. So I issue bond to you, but I do not have to have money from you, and you do not have to have. I do not have to pay you. So only when I really need money in case of something, for example, pandemic, or some like flood, natural disaster, that make the insurance company really need money in the short run, then I will require money from you. Income bonds is a very interesting type of bond. Only the face value of the bond is promised to be paid to the investor, with any coupon payment being paid only if the issuing company has enough earnings to pay for the coupon payment. So in that bond contract, the income bonds contract, it says, I issue the bond to you, and the principal, the face value, is guaranteed, but the coupon is not guaranteed. Totally depends on my performance. If I make money, I will give you. If I do not make money, I do not give you the money. It's more like stocks, okay? Like stocks pay dividends, but it's not guaranteed, okay? Convertible bond. A convertible bond is a fixed income debt security that yields interest payments but can be converted into a predetermined number of common stock or equity shares. That means if I as a bond issuer, I issue bond to you, and I'm promised to pay you face value plus the coupon. But hey, I'm not good at business, so I do not have money to pay you now. What do? I can go bankrupt, but we can negotiate to have another way to resolve this. How about you convert the bond that you are holding to the stocks? So you become the owner, and our interests are tied together. Actually, the convertible bonds have a significant role in the restructuring of the state-owned enterprises in China, mainland China. In the 1990s, some nationally owned companies, they were in financial trouble and they could not pay the bond, and they privatized some part of the equity. So the bond were converted into the stocks. Okay, it is widely used and is useful. Put bonds. It is just the opposite of the callable bond, the bond with call provisions. A put bond is a bond that allows the holder to force the issuer to repurchase the security at specific dates before maturity. The repurchase price is set at the time of issue and is usually par value. That means as you remember, callable bonds are that the bond issuer have the right, have the option to repurchase the bond at the specific when the specific events happen at the predetermined condition. The put bond is that the issuer being forced by the investors. I buy the bond as an investor. I can force you to repurchase my bond back at the par value. Question: for put bonds, are they safer or riskier? The answer depends on what person, what row are you in. If you're an investor, put bonds are much safer. It gives you another option. Okay. If you are an issuer, the put bonds are riskier because you don't know. Like, what about the investor just force me to repurchase a bond, but I don't have enough money at that time? Then this is a risk. There are many other types of provisions that can be added to a bond, and many bonds have several provisions. It is important to recognize how these provisions affect required returns. You just need to remember to analyze this kind of question. You just need to remember the required returns are linked closely to the risks, to the risk level of this bond, of this financial security. So you just need to remember how to analyze how the provisions affect the risk. Bond markets. The bond markets are primarily over-the-counter transactions with dealers connected electronically. Okay, so bond markets do not really have a lot of exchanges like stock exchanges or futures exchanges, commodities exchanges, more like over-the-counter. One reason is that bonds are not very standardized, or the bonds are standardized as securities, but bonds are they're different for different corporations. The bonds trading volume is extremely large. Okay, and I'm sorry, the bond issuance volume is extremely large. Okay. But once the bondholders buy bonds, they do not trade them as frequently as trading stocks. Well, treasury securities are an exception. For the small company or municipal issues, it's really hard to get up-to-date prices because they probably are not traded every day. So you do not have today's trading price. For a small company, probably only 400, 1,000 traders, 1,000 bondholders are there in the world. So they probably don't trade every day. Treasury securities are the exception because the government, for example, the U.S. Treasury bills are really large volume. So there are numerous people trading them. But usually for corporate bonds, there are not as many traders. Think about like around you. A lot of people are talking about like trading the corporate stocks. How often you hear people trading the corporate bonds? Not really. Okay, bond trading volume can be, the bond issuance volume and the purchase volume can be very large. So the nature of bond determines that it is not a investment tool usually for the retail traders. Okay, it's more for institutional traders. While the institutional traders are like mutual fund, they can gather money from the retail investors. Like you give me like 20,000, he gives me like 50,000, and I pull all of the money together. Like I have $200 million. And I can use $200 million to buy some bonds. Okay. Treasury quotations. This is a quotation from the brokerage firms. The brokerage firms software, trading software. You can see that. So, what is the coupon rate on the bond. The coupon rate is 4.5. Okay, when does the bond mature? The maturity is said to be February 15th. In 15 years. I think this. Okay, I made this slide several years ago, 2016. So at that time, it should be 20 years. What is a bond? What is a bid price, and what is the ask price? This is an interesting thing. Bid price and ask price. I need some time to explain it. In the markets, we have buyers, we have sellers. Okay. And the buyers, they offer a buy price. The sellers, they offer a sell price. So when you see that in the software, trading software, you will find that the ask price is always on the upper side. The bid price is on the lower side. The sell price will be listed from the highest to the lowest. For example, we call that ask 1, ask 2, ask 3. The ask 1 will be, for example, 136.6. And the ask 2 will be another person saying, like, I'm willing to sell at the price 137. And then ask 3, another guy says, I'm willing to sell the bond at the price of 138. And for the buy price, so this is the highest bidder. We say the highest potential buyer. The buyer that offers on the current market, that offers potentially the highest price, 136.5, which is lower than the lowest ask price. Remember that whenever you see the bid ask price, the highest bid price or the buy price is always lower than the lowest ask or the sell price. Why is that? Because if the buy price is higher than the sell price, if the bid price is higher than the ask price, they will make a transaction. Okay, that deal will be transacted. If you find that anyone who says, like, I don't want to wait, okay, for anyone who offer an even lower sale price, okay, I just want to buy this bond at the price of 137. What will happen? Then this guy will be automatically matched electronically with the person, with the seller who offers the lowest sell price, because this guy are willing to sell at any price higher than 136.6, and that guy is willing to buy at any price lower than 137. So they will be matched, and the transaction will be made. And these two quotes, we say quotes and trades, those quotations will vanish from the system. So for all the bid price and ask price that you see from the system, the highest buy price or the bid price is always lower than the lowest sell or the ask price. Okay? If you still feel confused, advise you to open the brokerage account. And you can see the ask and the bid price from the software, or you can watch some videos from internet, and just Google bid and ask price. Remember, this is not it's not a difficult concept, but it's not a easy concept. I also spent quite a while back 15 years ago to figure out what it means. Okay. How much did the price change from the previous day? We look at the CHG, stands for change. So it gets lower for 1.7109. What is the yield based on this ask price? The ask yield is 2.3. clean versus dirty prices. The clean price is a quoted price. Okay. Recall the timeline model from year 1, year 0 to year 1 to year 2 to year 3. At the end of the year 1, at the end of the first year, second year, on this, just at the last day, on the last day of the year, you have the price as the quoted price. These are called clean price. The dirty price is the price actually paid, which is equal to the quoted price plus accrued interest. What if I ask you, what is the price of the bond at the end of March or at the end of April after the first year? But the compounding is annual compounding. Okay. What do? How to calculate? It's like on the timeline model, how to calculate the price in the middle of the interval? How to calculate it? So it's quoted price plus accrued interest. Think about the example. Consider a T-bond with a 4%. By the way, this could be tested in the midterm and final. Be very careful. Consider T Treasury bond with a 4% semi-annual yield. Remember, semi-annual yield. And so the compounding is every 6 months. And the clean price is $1,282.5. The number of days since last coupon is 61. And the number of days in the coupon period, 6 months, half a year, is 184. So accrued interest will be the lengths that have been passed, the time has been passed since the last coupon payment, which is 61 divided by 184, times the semi-annual coupon, which is 4% times face value 1,000. So you know the accrued interest is $13.26. The dirty price is simply the quoted clean price, 1,282.5 plus that accrued interest, and we got the dirty price. Okay. The dirty price is higher than the clean price because of the accrued interest. Why the accrued interest? Because as an investor, as a seller of this bond, I have been holding 61 days. So my investment has accrued some cost because I have an opportunity cost of holding this. That is the money that I have given up. I have invested into this bond for 61 days. But for this 61 days, if I sell the bond to you right now, I'm not getting anything from this period, from this 61 days. So you must compensate me. As a buyer, you actually gained. As a buyer, you are saving. You have saved 61 days. And during these 61 days, you used your money to invest in something else. So you need to compensate this seller for that 61 days. That's why you need to pay an additional accrued interest of $13.26. That's why the dirty price that the buyer pays the seller is higher. So you would actually pay this this amount for the bond. Inflation and interest rate. Okay, now we have finished talking about the different types and some features of the bond. Then we are getting to the inflation and interest rate. Real rate of interest, change in purchasing power. Real rate of interest is change in purchasing power. If you learned microeconomics before, you know that there are two prices: nominal price and real price. So because interest rate is the price of the money, so you have a real interest rate and the nominal interest rate. Think about this. How do you understand the purchasing power and the real rate of interest? If you invest in a financial asset using $100, and at that time, a restaurant meal is $100. So basically, the restaurant meal is $10. So basically, you were giving up 10 meals enjoyment and use this money to invest into a bond. And that bond paid you in 10 years $1,000. So the nominal interest rate will be 10 times, right? 1,000%. But in 10 years, you find that every meal is now $100 instead of $10. You find that, or you get 10 times more money, but this money can still just buy 10 meals. You find that your purchasing power doesn't change at all. So what is the real rate of interest in this case? 0. Although your nominal interest rate for over this 10 years is 1,000%. Well, this is a EAR, so you can calculate the 10 years EAR, and you can calculate the 1 year's APR or EAR. So the real rate of interest is a change in purchasing power. Nominal interest rate is the quoted interest rate changes in actual number of dollars. Because the government are keeping printing money, so we always have the inflation if the economy is growing well. Well, if you really have no inflation or deflation, you actually need to worry about the economy because the economy is really in trouble. But that's not in the scope of under this corporate finance. You probably want to review your microeconomics and macroeconomics class. The ex-ante nominal rate of interest includes our desired interest, real rate of return plus adjustment for the expected inflation. That is basically saying the ex-ante, meaning that from now, because after 10 years, in 10 years you will know the nominal interest rate from calculating back the historical numbers. So ex-ante, the nominal interest rate will be the real interest rate plus an expected inflation rate. This is called the Fisher effect. Okay, 1 plus the nominal interest rate will be 1 plus the real interest rate times 1 plus the expected inflation rate. Okay, which is equal to 1 plus small r plus h plus small r times h. We usually use approximation. That is, the nominal rate is equal to real rate plus inflation, because when r is the real rate is usually between 0% to 3%, very low, and the inflation rate is also around 2 to 4%. So the r times h could be really small. So approximation could just ignore, get rid of the r times h. But let's take a look at this example. If we require 10% real return, that is, small r is 10%, and the expected inflation is 8%. So h is 8%. What is nominal rate? If you use Fisher rule, you find that the uppercase r, the capital R is 18.8%. Approximation will just give you the 18%. So there is a huge difference of 0.8%. This is a huge difference because in this hypothetical example, the 10% and 8% are too high. Usually in European and developed countries and most countries in the world, okay, let me be clear, excluding the Latin American countries and Eastern European countries and African countries. Okay, so in Western Europe, North America and East Asia. Usually we can simply use the approximation because small r and h are usually very small. Lots of things about this slide. Term structure of interest rate. Term structure is relationship between time to maturity and yields, or else equal. It's important to recognize that we pull out the effect of default risk, different coupons, etc. We just assume that they're constant. They're just we do not consider them in this simple model. So term structure. When we are talking about term structure, we are talking about the yield curve. Okay, these are good terms. If you wanna pretend that you are professional in international or local conference, financial conference, you can just talk with the professionals about this, and they will think that you are at least a semi-professional. So yield curve is a graphical representation of the term structure. What does it mean? Let's take a look at this. So along this curve, okay, for the x-axis is indicating the different bonds with different time to maturity. For example, this is the same bond. No, I'm sorry, this is not the same. It's different bonds issued by the same government. For example, let me see. I'm not sure if you can see my mouse or not. I hope you can see my mouse. For example, this is 3-month Treasury bill, the U.S. Treasury bill. So for the U.S. Treasury bills, 3 months bill, 3 months bond, okay, time to maturity is really, really short, very short. And the interest rate is this. When time to maturities get higher, when maturity, here you are looking at the 5-year bond, and the interest rate is higher. And here is 10-year bond, 20-year bond, 30-year bond. The same institution, same company, or same government issuing different bonds, all else equal, just with different time to maturity. What are the interest rates? And you use a curve to link all the interest rates together. Okay. Then you find that the interest rate is going up. It's called an upward sloping term structure. And we also call it a normal structure, which means that long-term yields are higher than the short-term yields. You probably think like, what the hell? It should be like this. Of course it's like this. Of course, for the longer term, the bonds with longer maturity, of course the interest rate should be higher because you're compensating my risk, right? Remember that these interest rates are all annual interest rates, annualized interest rates. Of course it should be higher. Yes, that's why it's called normal. Okay, the nominal interest rate has three components. Real rate, remember there's a real rate, is a small r, plus the inflation premium plus the risk premium. Okay, this one is treasury bills. This is risk-free rate, and you also have so this second line is above the inflation premium is the risk-free rates, and here is interest rate risk premium for the upper parts. This is normal. Yeah, this is normal. And then this was tested in the midterm once and final once, if I remember right. Final or midterm. And a lot of people do not know how to do this. So I hope that you can still figure out clearly what term structure and yield curve is. Another type of yield curve looks downward sloping, and it's called inverted. Look at this. Okay, look at the figure B. This downward sloping term structure. You find that when the for different bonds issued by the same institution, when the maturity is longer, the annual interest rate is lower. What's going on? What's going on? Inverted term structure is a very important financial indicator in the bond market, and it matters for the macroeconomics. A lot of macroeconomists and analysts are looking at this term structure. The term structure getting downward sloping usually because the market is expecting that this country, this institution is getting much worse. The economy is getting worse in the future. Why do they expect that the interest rate will be lower in the future? Because they expect that in the future, the economy will be really bad. If you learn the macroeconomics, you know that when the economy is really bad, what will the government do? The government wants to use the macroeconomic tools to boost up the economy, right? How do they boost up the economy? They lower the interest rate. They print out money. Why did we have the quantitative easing? Why have the asset prices have increased so much in the past 10 years? Because of financial crisis. Because every country's government is thinking that, okay, the economy is getting really bad. When the economy is really bad, a lot of people don't have jobs because the investors don't want to invest. The businessmen do not want to borrow money from the bank and invest. They don't want to do business. They don't want to hire people. So these people don't have jobs. So these people, if they don't have jobs, they are unsatisfied with the government. What do? We tell the businessman, please borrow money. We give you a very low interest rate. You used to pay like 10% interest. Now you just need to pay 2%. Or we give you zero interest rate. How do we push the interest rate down? We print out a lot of money to increase the supply of currency. Okay. The governments, the Chinese government, in the past 10 years, the Chinese government, European governments, the Japanese government, the US government, they printed a lot of money. And well, actually, printing money is not very accurate. They actually use open market operations to purchase the outside treasury bonds so that they can inject liquidity into this economy. But you should have learned it in the macroeconomics. So the interest rate is down. Every time you see the downward sloping term structure, it indicates that the market means that a lot of investors, a lot of participants, a lot of investors, they anticipate that the government will do something to lower the interest rate, and the economy will be bad. So if you want to know how the market, how the world is thinking about one country's economy in the future, you do not need to do a lot of analysis. You just need to look at the term structure of the bond. This is another thing that I want to emphasize. This is another useful function of financial market, revealing the market's aggregate information and belief. Okay. You do not need to guess what others are thinking about. You just need to look at the market, the bond market's term structure. If you find that, it's not very difficult for you to find this. You just go to any financial trading software, and you look at all of the different government bonds. For example, Greek government bonds. You can find the Greek government bonds, a 3-month bond, a 6-month bond, 1-year bonds, annual return. And you find out all of this return, and you just put these dots, these numbers on a graph, and you just draw a graph. You see whether it's upward sloping or downward sloping. You don't even have to do this because in the market, a lot of analysts have done this, and you just need to download it and take a look. If the Greek government's term structure, bond term structure is downward sloping, you expect that the Greek government will go. You expect that there must be a lot of market players, investors in the whole world who invested or thinking about investing into the Greek bond, government bonds, have done enough investigations of their financial condition. And they find that, okay, this country in the future must have some trouble. This country in the future must have some economic crisis. So at that time, we anticipate in 10 years or in 5 years, the government will print money. Okay, then the interest will be lower. Then you see that the people vote by requiring higher interest rates or lower interest rate, or vote by buying and selling the financial assets, so that you see the downward sloping term structure. Anyway, upward sloping term structure is normal, because the longer the time to maturity is, the higher the risk is. So it is normal that the investors demand higher interest rates. So when time to maturity goes up, interest rates should go up. But whenever you see a downward sloping term structure, it means that the market is anticipating a economic crisis or not so good economic perspective. Okay. I think this is the last slide. The bond yield have several components. Okay, real return, the real rate, inflation premium, and risk premium. So we are talking about what factors affecting the risk premium. What factors affected the risk? There were two types of risks. The first is a market risk or systematic risk. The second is individual risk, or a more professional name, idiosyncratic risk. Pronounce this, idiosyncratic risk. Okay. It makes you sound so professional. So market risk is some risk that the whole market will have to bear. For example, will the US COVID-19 pandemic become better? Who knows? Nobody knows. Okay, you can only guess. Not even the president knows. Okay, nobody knows. So this is a risk that all of the companies in the US must bear. Remember that the market may not be just the country's market, national market. It can also be a industries, a sector's risk. For example, what kind of policy changes will the Chinese government make in 5 years? Will the Chinese government tax the real estate assets in 10 years? You say no, he said yes. Nobody knows. No one in the world will know for sure what will happen in 10 years. So this risk will affect all of the stock prices and the bond prices. And the bond issuer, these Chinese real estate enterprises, they will affect their risk. Okay, so this is a factor affecting the whole real estate market. This is a market risk. What kind of things will affect the whole world? Every firm at the same time. Will the alien invade the earth in 100 years? Nobody knows. Okay. Will pandemic be better? Well, now, currently, right now, it's 2020 September. So we know that the vaccine may come out and be used in several months. But back in February, we really don't know. That is a real risk that affects all the companies and market investors around the world. This is a systematic risk. Other than some factors that affecting multiple or all the firms in one sector or one region or one country, there are some idiosyncratic risks that only affect the individual firms. Okay. For example, is the CEO of that company healthy? Will that CEO couples, co-CEO couples, divorce? Who knows? But this risk only affects that particular firm. Okay. Will that firm have higher default risk? Default risk meaning that you borrow money or you issue bond and borrow money, but you don't have enough money to pay back. So you default the bond. Default means that I borrow money, but I don't pay. Okay. So that default risk is company-wise, is individual or idiosyncratic risk. Taxability. Will this company be taxed more? If it's not a policy change, it doesn't affect the other companies. Well, for the market risk, that can affect the bond yield. For example, the real rate of interest. Real interest rate. When the real interest rate changes, all the bonds yield will change. Like this fundamental thing will change, then all the bonds interest will change. And inflation premium. When this and this bottom, these two changes, this is what will change all the markets, all the bond issuers, bond prices, bond interest rate in the markets. But for this, risk premium is an individual risk to individual firm. Okay, liquidity, whether this form liquidity, default risk, and taxability. Okay, I think yeah. So these are the tutorials. So there's a quick quiz that you were gonna practice in the tutorial, and this is a comprehensive problem that you will practice in the tutorial with the TA. And this is all. So in this chapter, we learned the pricing of the bond, the pricing of bonds, the bond valuation. We learned the different types of bond. We learned the current yield and the difference between the current yield and the yield to maturity. We learned the feature effect, the components of the nominal interest rate, which is real interest rate plus the inflation, and this nominal interest rate, risk-free rate. Okay, the bonds yield will be determined by the nominal risk-free rate and also the risk premium. And we, at the end, we discussed a little bit about the term structure. Okay, so this is the end of the interest rate and bond valuation. In the next video, we will talk about the stock valuation. Thank you.